Hello, everyone. Today on the final bar, we'll address the market in full distribution mode. Broad sell-off across risk assets today. We'll talk about the movements in stocks, particular groups and themes and sectors. On Mondays, we hit the market from three directions. Top-down macro perspective, we'll talk about sector rotation. We'll talk about individual stocks. It's a heavy earnings week, so a lot of individual names to focus on and a lot already on the move. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we make sense of these markets together using the power of StockCharts, using the power of data visualization to understand the basic premises, the basic concepts of price and breadth and sentiment. Focus on the message that the markets themselves provide. I would argue, and if you've been watching the show for a while, hopefully you have caught the not so subtle indications that we have been in distribution mode. While the market's certainly selling off Friday and continuing its decline today, I think some of the signs have been fairly straightforward recently. We've had a lot of signs of distribution, particularly in the breadth characteristics, and that's where we spent a lot of time sort of focusing, continuing to decline now in terms of breadth, but the S&P hitting the 50-day moving average today, but not closing below it. So overall, we're still over in a constructive mode. The question is going to be, do we hold support on a lot of these charts or do we not? The challenge is on individual names. We've not been holding support. Now, we have great guests on the show. Last week was a lot of fun with some really knowledgeable, thoughtful comments from our guests. This week, we have more of the same. Tomorrow on the 20th, we have Dale Pinkert from Forex Analytics. On Wednesday, the 21st, Ari Wald from Oppenheimer. Then on Thursday, the 22nd, Jonathan Krinsky from Baycrest Partners in the New York area. Also, a couple other things to let you know about. The Pitch, our next episode of The Pitch will be coming up on July 27th. That's coming up next week. I will be moderating a fantastic conversation. It's a lot of fun to have three different experts all bringing their top 5 ideas. They will pitch you on their ideas. You will leave the session with some tickers jotted down and some ideas to keep in mind. Also, my next webcast for market misbehavior will be coming up tomorrow. This is Tuesday, July 20th. At 1 o'clock p.m. Eastern. If you're interested in that event called the Market Top Checklist, we'll talk about some of the signs that we've seen and what that means for downside potential. Go to marketmisbehavior.com/markettop for more information. Let's continue on with our market recap. So as I mentioned, the market distributing Thursday into Friday, continuing that today. And that was the real question, right? Was that sort of an aberration, sort of a one-off thing that you saw the market sort of distributing? Was just a brief pullback before rally? I would say a day like today with broad distribution, with all 11 S&P sectors down, with some of them down, significant amounts. Overall, I would argue we are in that downtrend phase. And so the question, as always, is how do you differentiate the short-term pullback from more of a long-term, corrective period? I shot a video for my own YouTube channel called Market Misbehavior end of last week, where we focused on some of the clear signs of distribution, particularly thought about some of the downside price objectives. If you missed that as well on StockCharts.com on the articles page, I wrote an article talking about that. There's indications of a correction and how a potential correction may play out. We'll talk about some of those, some of that. But to be honest with you, looking at a chart of the S&P, and then we'll come back to today's, the reaction overall today on the macro side. When you look at a chart of the S&P 500, we have crossed one threshold where we have made one step in the distribution direction. Now, there have been plenty of signs. Momentum divergences, absolutely right. Breadth divergences, absolutely right. But I would argue the end of this week into the beginning of this week, the end of last week into the beginning of this week is when you've really started to see price recognize more of a distributive pattern. We broke below the swing low from about a week and a half ago. And most importantly, on Friday, we closed below this trend line that we've been talking about for quite a while. If you take the low from late October, the low from early March, you connect that to the lows in May, again in June, early July. We broke that on Friday, and my comment on Friday's show was, do you get the follow through going into next week, indicating further downside potential? I think we got that well with today. Now we're again at the next level of support, right? The next level. And what's interesting is if you look at the 50-day moving average for the last 8 months, we have closed below it a number of times. Actually, that's not true. Only twice. We did it once in March and then again in June. Both of those times we closed back above it the next day. We traded down to it a number of times. It's been touched 6 or 7 times since the breakout in November into December of last year. And so the question is, are we able to break down through the 50-day moving average? If we do, this all of a sudden puts this in a very different scenario than we've seen in some of these other times. The real line in the sand, and for me, looking at individual charts, it's all about what I call the line in the sand. What's that level that, regardless of how much you think the narrative is still bullish, regardless of how much you hope the price goes higher, and regardless of all the fundamental reasons why you could justify the market going higher or the particular asset going higher, what's that line in the sand that when we break that level, you just have to throw in the towel, either mentally or literally with your position, and say, it's not going up anymore. I need to change my positioning or change my risk perspective. I would argue on the S&P 40/50 is the level, right? We remain above that. We hold that like we did here in May. And overall, you could argue, while there's been short-term distribution, and this would overall be a 7 to 8% pullback from the mid-July high. That's not a small. That would be the deepest correction so far year to date, the deepest pullback. But the real important thing, if we would get down to that level, is differentiating the garden variety still pullback within an uptrend versus something that's much more distributive, where we have to start looking at real long-term levels of support and talk about things like 3,700 and 3,200 and bring some of these shaded areas that at times I've thought about removing them from the chart because they're so far away. Now, all of a sudden, I'm glad I've left some of these here because these are the levels that I think are pretty meaningful if we do start to distribute it in a more significant way. So step one, we break the 50-day. That is, I think, what's now in play for the remainder of this week. Step two, if we do break the 50-day, you have to start looking at a lower low, the most significant low. And most of my guests last week identified this same level, 40/50. I think that's sort of a consensus level. And the reason why that's important to know is if we would break 40/50, I would brace for a flood to the exits, because that's where people might expect support. If that breaks, you really have to think about deeper risk, deeper downside potential, getting more defensive, starting to take bets off the table if you haven't already. So overall, don't get me wrong, the S&P, I would argue, has been showing signs of distribution for a while now. I think this week's, the sell-off over the last 5 trading days has really started to accelerate. I don't think it's done yet, but first things first, we need to get below the 50-day moving average. That's what I'll be looking at, certainly going into tomorrow. And what's interesting is we're doing this in a heavy earnings week. Some of the companies reporting this week, and sorry, I'm grabbing the list, which was way over here. It's so far we had a couple today. We have IBM after the close today, but it really accelerates tomorrow. Things like Netflix reporting on Tuesday, United Airlines, a number of the airlines reporting Wednesday morning, Johnson & Johnson, Verizon, Coke, Harley Davidson. Thursday is a beast of a day with Intel, Twitter, a couple airlines, AT&T, Freeport, McMoran, D.R. Horton. So there are potential catalysts, especially for individual names, to resist this downward pull and start to bounce higher. But the absence of an upside catalyst from earnings season could be pretty detrimental to the bull case, because that is a potential catalyst that could cause things to go higher. If that's not going to work, and arguably we saw that with the financial stocks, right? The banks, which even if they had decent earnings, really didn't show upside movement after that. That would be something to pay attention to this week. Very quickly, and sorry, I was going through some of the scenarios there. The S&P down 1.6, small caps down a little bit more. The Nasdaq a little bit outperforming, but still down 0.9%. The real movement in the fixed income markets, with the TLT up 2%, 10-year yields down below 1.2%, which is a significant move. We'll have to leave it with the chart of the TNX. Let's go over here. This is the 10-year yield. So we've talked about yields being in a downtrend. We've talked about the potential for yields to go lower, and the bull case that we've seen from bonds. And my guest, I think it was last Thursday, Christopher Mullen, talked about the upside potential for the fixed income markets. And so far, I think his comments are playing out beautifully. I think on the chart of the 10-year yield back here in March, same with the chart of the TLT or the AG, you saw these divergences, the momentum divergence. Here you saw the 10-year yield spike up to 175, but the RSI sloped downwards. It's a bearish momentum divergence, indicating a downside exhaustion in bond prices and upside exhaustion in yields. That's been the high watermark so far. But if you look at what's happened in the last couple of weeks, we've really started to roll over breakdown through key support levels, and now we are below the 200-day moving average for the first time since last November. We've broken the first Fibonacci support level, taking the low from last August and the high from March. I think there's further downside in yields, and I'm now looking at 1% on the 10-year. So the question I would be asking myself as an investor, what happens to my portfolio if we get back down to the 1% level on the 10-year, which seemed ridiculous a couple months ago, but now all of a sudden very much in the area that we're not too far from. Let's continue on from our market recap, go to the sector setups. We'll talk about the 11 S&P sectors, what sort of movements that we're seeing there. When we look at the S&P just today, and then we'll look at the RRG and talk about some of the bigger movements, all 11 S&P sectors down today, with consumer staples and healthcare doing the best, right? Up the, or down the least, really, with consumer staples down about 1/3%, healthcare down 1%. And we've talked about some of the charts within consumer staples that have been okay. Staples, obviously a very defensive sector, and so there could be opportunity there to hold on to things that are performing well. What's really pushing the market lower today? The cyclicals. Energy at the bottom of the list had been down a little further, over 4%. At the end of the day, down about 3.5%. Financials down almost 3%. Materials and industrials over 2% to the downside. So, the question is, can the market hold up with technology doing well, the FANGs holding up, and things like the cyclicals rolling over? When we get to the individual stock portion of the show, we'll see that the FANGs not holding up on a price basis, perhaps on a relative basis, which is a key thing we'll have to potentially start to think about, especially in a corrective period. But overall, the weight of the market, the overall risk-off feel is too much for even the mega cap tech and consumer stocks to resist the downward pull. Let's look at the 11 sectors on the RRG. So the relative rotation graph is a beautifully designed visualization by Julius de Kempener. If you're not familiar with this, check out Julius's show called Sector Spotlight. It does a great job of describing this methodology and using it real time with a lot of great examples. But here, what we like to do is look at the 11 S&P sectors, how they're rotating around the benchmark, which is here at the crosshairs at the 0 line. Further to the right means the sector is outperforming. Further to the left, it's underperforming. The vertical gives you sort of the momentum behind that. So above 0 means improving momentum. Going down below 0 means weakening momentum overall. Look at what's happened on some of the cyclical sectors. This is using weekly data that we're looking at. So it's a little more of a long-term view of sector rotation. But look at how energy had been improving, or really starting to head in the direction of improvement northeast, now has rotated, taken a big left turn and heading southwest, or what I would call the direction of deterioration. All of the cyclical sectors are in that same grouping, right? You have energy, financials, materials, industrials, all in the weakening quadrant and all heading southwest, which is not the direction you want to be. What you want to be in general are looking for opportunities in sectors heading in the northeast, ideally in the improving quadrant, which means they're really starting to roll up. They're really starting to gain some momentum. The strength, where you hopefully already are, is the leading quadrant here up and to the right. Only 2 sectors still in the leading quadrant, only one of them arguably that is in a position of strength, if that, which is the real estate sector, which is the furthest to the right and the furthest positive. Followed very closely by 2 other sectors, which I would highlight here: technology and healthcare. So when you're looking for opportunities, stock, and I would argue in this sort of environment, what do you do when there's a broad distribution, there's a broad sell? It feels like everything's going down. Well, it's tough, because in a bull market phase, when everything's going up, the question is, what do I underweight, right? Or where do I take profits, right? And where do I not make my bets when everything's going higher? And the answer is, you stick with what's working on a relative basis. Look for what's outperforming, and stay away from things that are not participating in the uptrend. In a downtrend environment, when everything starts rolling over, which on a day like today feels like everything's down, which it mostly is, the question there, or what you want to try to be, are things that are not going down as much, things that are underperforming. So most things are going to show a negative pattern on price. Focus on areas that are outperforming. Focus on stocks where the relative strength line is going higher. When we get to the shifting stocks segment a little later in today's show, we'll try to highlight some of those stocks that are showing more positive characteristics, more defensive leadership that you may want to focus on. But looking at the 11 S&P sectors, it's clear that the cyclicals are not the place to be using the RRG methodology, and it's looking at a couple narrow group of sectors that are still outperforming and showing improving characteristics: real estate, technology, and healthcare. Let's look at the 11 S&P sectors now using the candle glance page. So especially in this sort of environment, when things are really starting to distribute, the candle glance page allows you to sort of differentiate what is working and what's not on a relative basis, what's breaking down more relative to some of the other sectors. And there was a time not too long ago, and I'm thinking more in the first quarter, where it felt like all 11 of the S&P sectors were going up. And for the most part, they really were. If you go back to like March, April, May sort of period, sort of everything making new highs or very close to that, most, if not all of the 11 S&P sectors above their two moving averages. Now, all of a sudden, you start to see some differentiation. You see sectors that are holding the 50-day for now. And those stock sectors would be the XLC, the communications sector, trading down to its 50-day moving average today, again, much like the S&P itself. The consumer discretionary sector testing its 50-day moving average as well. What else comes out when we look at these 11 S&P sectors? Let's see. We have consumer staples actually holding its 50-day. Technology, arguably the most constructive, followed by healthcare and real estate. We talked about those are the three that are holding up on a relative basis. Let's look at the three of those, and you can see while things like communication services, others are testing their 50-day already. Things like healthcare are actually not down to their 50-day yet. You can see how the relative strength on healthcare is actually close to making a new 5-month relative high, which is an important chart to pay attention to. Healthcare was number one. I think technology was a second one. You can see there's a lot of daylight between the price and the 50-day moving average. You can see how the relative strength has been improving. The last one, I believe, is real estate. Continue to make higher highs, so far holding a higher low, so far holding its 50-day relative strength improving. When you're looking at sectors, especially in this environment, I would be leaning into the sectors where the relative strength is improving. Those are a couple of them that stand out to me right now. We need to take a quick break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thanks so much for joining us every weekday after the close for the show. As a reminder, we'll be going back to 4 p.m. Eastern live starting Tuesday, the 20th. So look forward to seeing you live at 4 o'clock p.m. Of course, all of our episodes will be on demand and on our YouTube channel as well. A couple of quick comments before we get on to shifting stocks. Number one, we love to hear from you, particularly questions that are coming up as you are analyzing your own charts. Please think of us as a resource helping you along the way using stock charts to understand the market environment. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Just put a comment below the video that you're watching on the Stock Charts channel. We'll gather all of those questions. Hope to answer one of your questions on our next mailbag segment on Tuesday's show. Also, as a reminder, go to stockchartstv.com. Use your email. Set up a free account. You can start watching all of our fantastic comments, our great hosts, our wonderful guests, guys like Ari Wald, Jonathan Krinsky, Dale Pinkert that I have this week. Also fantastic special events like The Pitch and Charting the Second Half. All of that on our on-demand platform. Go to stockchartstv.com. We're also on all the app stores. Just search for Stock Charts TV on demand. Continuing on with our next segment is called Shifting Stocks. So we have this three-pronged approach every Monday. We talk about the macro environment, how we've seen broad distribution in equities leading up to this week, but so far today, showing us that this week may continue to show further downsides. I don't see any sort of bottoming signals just yet. I think this is the beginning of something a little further and deeper, but we have to break the 50-day moving average first on the S&P, which we just tested today. Let's see if we get it close below it going on through the week. Finally, we'll also talk about interest rates going lower, the 10-year bond and the 10-year yield going lower, and things like the TLT and the ag breaking out to new swing highs. Talk about sectors, talk about three sectors in particular: technology, real estate holding up very well, and thinking about some of those patterns in technology and healthcare and real estate and how they're the three that are showing some space between the current environment and the 50-day moving average. Finally, let's talk about some of the individual names. And part of my own process every week is to go through a bunch of individual stock charts, and it's going through all the members of the S&P 500. It's running a lot of screens for looking for stocks making new swing highs and swing lows. And what I'll do now for the remainder of the show is share with you some of the themes that have come out of that. First off, I would say with this sort of environment, you have to start with the FANG stocks. The argument has been, and what's helped the market in previous bull market cycles or previous transition periods, is you have a lot of individual names that are breaking down, and particularly we've seen the financials, the energy stocks, and so forth that have already broken down, arguably so far, right, and broken support, not able to hold support levels. But you've also had some of these mega cap tech consumer communications names that have been holding the market, arguably holding the market higher artificially, and that's not fair. And I saw a post over the weekend, people saying, well, if you take the FANG stocks out, here's what the S&P does, and it's sort of, well, if you take the best players off the team's going to lose. Like, that kind of makes sense, but I don't know if that tells you about the team. That just tells you that those key players are pretty meaningful. So the key players, your starters right now, are the FANG stocks, things like Facebook and Microsoft and Alphabet and Netflix and others that have had really good trends and are also huge mega cap names that are able to hold the market up. However, we're now starting to see some short-term, some tactical signs of distribution, but not really the end of the world scenario, not really the breakdowns of support just yet. But this is a key group of charts to watch, of course. When I'm looking at things like Facebook, it's not broken yet, right? It's broken maybe the low from the last week and a half, but it's still above an ascending 50-day moving average, which it's been since last March, when it really started to exert itself in a leadership role, right? You've forgotten, because things like Facebook have been such strong names in the last couple months. But remember back here in the third, fourth quarter of last year, these were chronic underperformers. We talked about the end of the FANG stocks as things like financials and industrials and energy stocks were really starting to move to the upside. This is sort of the emergence of the infrastructure trade, the cyclical starting to outperform. Facebook was actually in a consolidation phase, if not a flat out downtrend, really into the first quarter of this year. Then March happened, and you really saw a rotation away from some of those previous leadership names into the FANG stocks. This is when Facebook broke to new swing highs. And so overall, it's been in an uptrend since then. My question for something like Facebook, something like Alphabet, are these stocks able to hold their 50-day moving average on any sort of decline? Both of those stocks have been able to do so for the last 6 months. I think their inability to hold the 50-day, their breaking down of previous support levels would indicate very much a cautionary pattern, but overall, the relative strength on both of those charts, for the record, still look fairly constructive. Can they hold the 50-day? Other things, and I'm going to go rapid fire through a lot of different charts. There's things that caught my eye. When I'm looking at the chart of Tesla, especially in the short term, you've sort of become range bound now. We've bounced off of the 550 level a number of times. We had this beautiful rally, break above trend line resistance. If you take the previous highs, breaking above that line, breaking back above the 200-day, back above the 50-day, all of a sudden it felt like the return of Tesla going back to 900, if not much, much higher. But then we stalled big time right around the 700 level. And so the question now is, we are range bound. At some point, one of these has to break. We break above 700, we break below 550. I would argue the direction of that break, whichever way it is the indication of new momentum. That new buyers would be required to push the price above 700. New sellers, or an exhaustion of buyers, an evaporation of buyers, would cause the price to go below 550. I would argue whichever one of those breaks happens, I would brace for much further momentum in that direction. So it's not necessarily giving me a clear directional sense. It is really the definition of sideways, with holding between two levels, with the RSI right about at 50, and relative strength is essentially flat. But I would be watching that chart to see which way it can break. Mohawk is another interesting one to pay attention to. Charts like this within consumer, when you think about the rotation lower that we've had in the consumer space, when we think about the chart of the S&P, just starting to break, I'm immediately coming to things like Mohawk, which have arguably already broken, right? Going into this week, you had a pattern of breaking below the 50-day moving average, making a new swing low. Now, all of a sudden, making a new lower high below the 50-day. Today, where it's sort of testing support again, while it could hold, absolutely right, this could be the bottom and a new rally. That absolutely could happen. I just see that as a very low probability. What I see as a much higher probability is a break of support, which completes this total transition from accumulation phase to distribution phase. And it's not just, that's not the ticker, it's not just Mohawk, but Ross Stores, a lot of others in this sort of apparel space are in that similar sort of pattern. I think they've already been in a distribution pattern. The RSI failing at 60 on Ross Stores earlier this month. Today's breakdown, today's sell-off and test of support, while could be the end of the move, I don't necessarily see that. I see those as more negative than positive. I would say other general themes to think about, two main ones. We don't have much time, unfortunately, to go through a lot of these, but I'll tell you this, the two other themes I would pay attention to, number one, failed breakouts, and number two, stocks that are holding up, right? Stocks that you may want to lean into because they're actually working. The failed breakouts, looking back, if we do get a major sell-off from here, the chart of Amazon may be the example. Apple may be another one, which are charts that in a bullish environment, if all is well, sort of classic configuration, this sort of base, a 10-month base, and we break above highs, should be a layup riding to new highs. And it still could be, because now I would say we've broken out and now we're testing that resistance, testing that breakout level from above. This would be the time when this type of chart would normally have the pullback and now rally and make it higher. If this fails, if Amazon gets back into that range, I would argue the chances of us going materially higher from here, not just on Amazon, but on the broad market, I would say are minimal, because we have a pattern of failed breakouts. There are other charts, by the way, that are failing, and just maybe one other. Chipotle is another one that comes to mind, right? Resistance in February, resistance in April. We broke above that, and now we're coming back. So again, if this is going to work out, this is about where these charts should bottom out before they ride the next leg higher. If they fail and go back within this range, I think the chance of a bull case from here is limited, if not completely non-existent. So the other question is, where do you go? These are the types of charts. I'm really having ticker problems today here, just remembering, there they are, GNRC. Charts like this, ones that are overall still in an uptrend, charts that are pulling back a little bit, but overall still showing the characteristics of a bullish trend, still not far off of the overbought region, the relative strength still strengthening. Charts like GNRC fit the bill. Charts like Microsoft sort of fit the bill. Again, pulling back a little bit today, but everything is. Overall, it's still outperforming, still in an uptrend. PayPal would fit this sort of configuration, arguably. Tyler Technologies, TYL. Maybe those are not quite as much breaking out. Illumina, ILMN, which is a biotechnology name. These are charts that if you didn't know that the market was coming off so much today, you wouldn't necessarily get that message. I would focus on the outliers, charts you really see improving relative strength, and things are not too negative. We need to wrap the show for today, though, and go to the 3 and 3, 3 charts in 3 minutes. Here we go. Chart number one is my chart of the FANG stocks, the NYSE FANG Plus Index, and 6 of the charts that comprise those, what I call the FANG Man names, or Fan Mag names, perhaps, things like Microsoft and Netflix and others. All of these obviously coming off today along with the overall market, but not all of them in too bad of shape. They're actually holding up pretty well relative to other names out there. So the relative strength still holding up okay. My question, because the bull case has been, the cyclicals are selling up, but the FANG stocks are holding up. This is the chart to watch if the FANG stocks are indeed holding up, especially names like Apple, which have recently broken out. Are they able to hold those breakout levels or not? Chart number 2 is the TLT breaking out to the upside, interest rates breaking lower. I was asked about how low interest rates could go last week in an interview, and I mentioned 1%, which elicited a bit of a chuckle because it seems so far away, but it really isn't. And I think when you look from 175 to 1%, that's a big move in the 10-year, but it can certainly happen. The TLT can certainly go higher from here, which is what we're seeing. And I should note on my list of tickers to talk about, at the very bottom of my list of equity tickers, I wrote TLT in bonds, and I circled it because arguably out of all the charts I'm looking at, that may be the most constructive. Finally, just to finish off the 3 and 3, I would point out charts like ILMN, and I would say, in this sort of environment, if we do continue to see broad distribution, you see breadth rolling over, it feels like everything is going down. The question is, what is not going down, or what's not going down as much? Charts like ILMN that are able to hold up when other stocks are going down, when everything's down, look for those little moments of green on your watch list, on the market carpet, on the chart list that you're looking at, and those are the ones I would focus on. Things that are able to buck the trend, hold up, and actually show some appreciation, particularly the relative strength line at the bottom of every one of the charts that I tend to show on the show. Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. As a reminder, we're going to move back this week to 4 p.m. Eastern, running the show live. Excited to have you back live every day at 4 p.m. Eastern. We'll, as always, show the show a little bit later on demand and also on our YouTube channel. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night. We'll see you tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.